Hey guys, V. Rigoni, Max, high performance real estate entrepreneur. So, what we're going to be talking about today are the winners and the losers when it comes to these higher interest rates, right? Because there's always winners and losers. Whenever there's a disruption, and when you take interest rates up 11 times, I think it's 11 times in over 18 months, you're going to have winners and you're going to have losers. Now, the question is, where do you stand? And how are you positioning yourself? Are you going to be a winner in this thing, or are you going to be a loser? So to learn more, stay with us. Let's subscribe to the channel. Let's leave some comments, and we'll talk more. So you got to stay to the end because we got some stuff going on here. You're going to want this information. So when it comes to real estate, when it comes to the fact that interest rates have gone up as high as they have, I mean, in my entire lifetime, I've not seen anything like this before. I mean, the only similarity would be, and it's a far similarity, is when they took interest rates back in the late 1970s from about 9%, and they jumped them from on a homeowner's basis. We're talking about homeowner interest rates here, up to about 16.5%. Now, that was an extraordinarily big jump, right? Now, one could argue that it was already at 9%, and that was high, but it wasn't even a double, because a double would have been 18%. So it's around 80% increase. Well, when you look at what has happened today, a mortgage on a home, you could get a fixed rate mortgage 2 years ago for 2.5%. Some even got them for less. And so they took that fixed rate mortgage based upon raising the Fed fund rate to 5.25%. That fixed rate mortgage now is sitting at about 7.5%. That's right. 7.5%. What is that? You're looking at about 200 times and more. So you go from 2.5 to 7.5. That's a 5% increase. That's insane. So that's a 200% increase. And so what has that done? Well, it's created a situation in the economy, real estate specifically, but then there is what they call collateral damage. And that collateral damage has moved through parts of this economy that relate to real estate. And we're really starting to see that now. And we're seeing that because, the number of home sales have been down like somewhere around 40% for now the last year. It's just, that's what's happening. Now, apartment building sales, the number of transactions. Now, we're not talking price right now. We're just talking transactions. They're down between 75 and 78%. So then who lines up to be the winners and the losers? Well, let's first talk about the losers, because it's a much longer list. And we'll leave the who's the winner for the end, because that's where the gold is, right? The people that are in the loser category right now, some of those people really had no other choice than to sit there and let the truck roll over them. But boy, if you know what's going on in the general economy, if you can do some basic forecasting, if you can see where the Fed was 2 years ago and where they're at today, and if you were in real estate, if you were doing things, you could have made some adjustments. Smart people did. So we're going to figure out who those people are at the end. So stay with it, and you're going to get it. So who are some of the losers? Well, the American public, right? The generalized number of Americans who are out there just wanting to buy their first home, second home, third home, and they want to buy a house. So how do they become a loser in this process? Well, because home prices have not fallen much. Sellers have stopped selling. So the American public who wants to buy a home, they have less inventory to look at. At the same time, their cost of borrowing has basically, it's going to be up 100%. So their mortgage payment is basically doubling. It's insane how much that is, right? And so they're buying somewhere between 40 and 50% less house. That's right. Because when you buy a house, yeah, the price is one thing. It's the mortgage payment. You sit there, and when you buy your first house, all you can think about is how much freaking money you're going to owe tomorrow after you sign those papers. That's why people get what they call buyer's remorse. I was just talking to a young couple the other day, and they're trying to buy their first house because the rental they're in is getting sold. And So they're getting out there to trying to find something. Well, the husband, he's got buyer's remorse because he woke up the next day after signing the contract and he's realizing he's going to owe like $260,000. And the most he's ever owed was a car payment in the past. Well, but you get past that, in the real estate business, you get past that. And so, but the reality is what he really owes is what his payment will be next month. Isn't that right? What's your payment? You can't look at the fact that you sit there and you owe $260,000. You'll never get out of bed. You'll be so freaking depressed. Now, we're not talking about the positive aspects of real estate here right now. We're just talking about the fact that you'll wake up one day and you owe $260,000 fucking dollars. But the reality is that's paid off a little at a time, right? It's an amortized loan. We'll get into that in another episode. But basically, he's waking up to maybe a $2,300 payment. Now, that may seem like a lot. Well, yeah, but last year, that same payment might have been $1,200. 2 years ago, not last year, but 2 years ago, might have been $1,200. Now, I know you guys are out there with your calculators because I used the number 260 and now I'm throwing out some, no, they don't necessarily correlate. What I'm just trying to say to you is people are spending a whole hell of a lot more money today. They have their incomes have not gone up much, but they're spending basically close to twice as much today for a mortgage payment because that's what's due in 30 days, right? The principal of $260,000 isn't due. It's the payments due. So yeah, they're now they're paying a big payment. And so that's really starting to affect people. So whether you can buy or not buy, I mean, yeah, you end up in the loser category here because you can't buy what you wanted to, and 2 years ago you could have. Now you might say to me, Vic, I wasn't in a position. I get it. But there were a lot of people that were in positions to do something in real estate a couple of years ago, and they didn't do it. I mean, let's get real here. So, but the reality is it's costing you a whole hell of a lot more money today. So that's got to put you into the loser category, right? And that's just the way this thing rolls. Now, let's hope that, you can jump back over into the winner side if these interest rates start to go down, and then you can refinance that loan, and hopefully your equity will have risen. And so if you use the minimum down payment, maybe you can get rid of that private mortgage insurance, because now after a year or 2 or 3, the property value will grow and you'll do some fixing up. And so then when you get it reappraised, hopefully at that point in time, you're then going to be getting a lower interest rate. And at the same time, you can shed off that, you can get rid of that PMI, the private mortgage insurance at the same time. And then you'll just definitely be jumping over into the winner category, right? So, but right now, when you're paying the kind of mortgage payments people are paying now for the same house they could have bought 2 years ago for, basically close to the same price. But even if they would have paid more 2 years ago, it don't matter. Their payment would have been substantially less because they would have had a 2.5% or 3% mortgage. I was listening recently to a show where the guy was on there talking about the fact that the loan officer, that 80% of the people in this country have interest rates that are 4% or lower, 80%. Now, another stat that I had heard was the average homeowner has a debt of 3%. But what they were doing in this calculation is they were adding in people that had no mortgage. So that somehow they added that into their calculation, and it showed that the average homeowner, didn't have a rate of more than 3%. But then you had to, in order for that to be true, you had to include the people who had no debt, which I think is kind of a, it's kind of a push. But in the same token, it's stopping those people from moving. So then your general public that wants to get into their home, they're right now in the loser category. So who else is in the loser category? Well, in some respects, sellers, people who are forced to sell. So the American public who wants to buy, they're in the losing category. And now the American public that wants to sell, they're now moving into the loser category. Why is that? Well, because in many cases, their next home, unless they're retiring and they're going to pay cash for their next house, which some people do, but we're just talking about the general population here. I mean, we're not talking about a prison, but we are talking about the general population. And lately with housing, you might think you're in prison, but I digress. So in any case, the reality is that they can't sell. They literally are, in some ways, imprisoned in their home. And you might say, well, then why can't they sell? Well, because then once they sell, what do they become? They become a buyer. And if they have to get a mortgage, most people want to sell because they want to, they want to get bigger. They want to grow, get a bigger house. They want something nicer. They want something in a different location. And chances are, if they're going south, it's going to be more expensive. And so that's what they want to achieve in their next purchase. But then that's going to come along with what? Well, now they jump over into the buyer category. And so then they become, into the loser category. So in some respects, both sellers and buyers in this marketplace are both in the losing category. Does that make sense? Because I don't know too many people, that want to sell and get rid of a 2.5%, 3% mortgage and just move down the block to get an extra 400 or 500 square feet bigger house and then end up with a 7.5% mortgage. That sounds to me like something that's kind of stupid, right? So that's the issue. Now, if they don't want to sell, well, then they're not in the losing category, right? Because they don't care. But when you drop transactions by 40%, and there is what is called, and the inventory levels drop tremendously, that's because people who might want to sell under normal circumstances have decided not to. And so that's got to, have some pressure on their life. So you got your consumer, right? You got your home buyer, your home seller. Who else is in that category? Well, let's talk about real estate agents. You don't see them anymore, right? They're giving up their licenses again. This is kind of like what happened in 2008. This is what happened back in the 1980s, is that when you go into an extended, downturn in real estate, I'm not saying recession. I'm just saying an extended downturn in real estate. There's fees that have to be paid. There's costs. And then people start to do what? They start to either age out, because all the people that were thinking they were going to retire from real estate or get out of it or whatever in a couple of years, well, a lot of those people are saying, hell, what's going to be there in a couple of years? So I might as well get out now. And then you have all the part-timers, and real estate is full of part-timers. I think I remember one time being in her hearing, this is back in the day when I was in real estate, and they said the average agent in America made like $14,000. Well, because the average agent in America is part-time and doesn't sell much real estate. But in this case, both part-timers and people that were making a lot of money selling real estate, they're both up the creek without a paddle, right? Because if transactions have fallen basically by half, well, yes, some people are making some sales, but nobody's, pounding the drum of how great sales in real estate are. And they weren't great last year, and they're not great this year, and they don't look like they're going to be great next year either. So that means that those people start to get out of real estate, and they start to change what they're doing. They start becoming bartenders. They start becoming servers in restaurants, or they go into retail if there's a job. They look for other things to do if they need to make a living. And if they did this as part of their retirement or whatever, they say, oh, I don't need the aggravation. I'm not making any money. I don't want to fight with it. And so they leave too. So there's what we would call, they call in the world of cattle, there's a culling of the herd, right? Right? They're culling the herd. So the herd is getting much smaller. And so those people, you could have to say that most of those people that are leaving, if they're leaving due to the downturn of real estate, it has to put them into the loser category. Now, who's right with them? Well, loan officers, right? The people who make the loans, right? They're usually recommended by the real estate agent. Hey, use my lending guy or my lady. She'll get that mortgage through easy. Or they're the best, blah, 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 blah. And these people build these relationships with individual lenders, and then they refer them. Well, if sales are down 40, 50%, how many referrals are going out to loan guys? Plus, who's refinancing a loan to a lower interest rate today? So they're getting whacked twice. They're getting whacked on both new home sales. It might mean new, I mean new and used, just home sales. And then they're getting whacked on the fact that for years they were living off of lower and lower interest rates. And people, it takes people sometimes a long time to wake the hell up. And, back back a few years ago and refinance out their 7% loan, their 6% loan. It takes people years. And so there was all that gravy train. Now, one can argue that gravy train will come back. I get it. But there'll be a lot less loan people in the business in a year or 2 or 3 years when the gravy train starts up again versus right now. Does that make sense? So all those people are affected. They're all dislocated. Now, what about their processors? Do you need as many loan processors? You've heard that term, right? So you don't have the loan processors. You don't have all those people, the people who prepare the documents, all those people get cut. All those loan brokerage companies. And then the banks, right? They start the same thing. Now, the banks have had another issue because of their bad investing into treasury bonds, long-term treasury bonds that got hit in their value. So banks are in the loser category too here. They've taken up a big seat. So you've got the general public, right? Both the buyers and the sellers. You've got the real estate agents. What about and we didn't talk about this, but what about the assistant to the real estate agent? Well, if sales are down, do you need an assistant? If sales are down, do you need an assistant now to prepare the documents, follow up with the showings, to give feedback to the sellers? No, you don't. So what happens to that person? They're gone too, right? Now, what's another category besides real estate and loan officers and banks? Well, what about the surveyors, right? They're in that camp. They're losers. They're losing every day right now. Why? Because just like the loan companies, they were making a shitload of money off the refis when some of these refis required surveys. Some didn't, but a lot did. And then the general buy and sell of a property usually requires to have a survey done. So these guys are in the tank. Nobody wants to be a surveyor today, I can tell you that. So they're in the tank. Who's in the tank right next to them? The home inspectors. So if you don't sell the houses, just like the surveys, you don't need the home inspection. A whole lot less of them, right? 40, 50% less. So you got people there either, losing their businesses, cutting their businesses down. When their business grew, they went from working out of their house to working, having an office. Well, now they're closing their offices and they're moving back into their houses, or they're moving out of the business totally because it costs money to be in business. And then there's a cost of time. If they're making almost no money doing this and they need to make a living, they need then to make a change. And so you have those people that are in trouble. All right. What's another? Title companies, right? That's where you usually go and sit and close the deal, is at a title office. Well, those are closing up again, right? So once those people lose, then the leases are lost. In some respects, the landlord loses because they lose their tenant. Because do you need as many title searches on titles? And then do they need to insure that title like they did before? No, they don't. So all the people who work for not just the title company business, but then there's all the employees that have been working for those title companies, they're going, right? Some go right out of business, and some of the staffs just get extraordinarily cut. So now you're down to those people. So you can see. Now, what's another person on the list that nobody really likes, but they're on the list? And that's lawyers. Lawyers make a shitload of money telling you where to sign the document and having their secretaries their paralegals prepare the paperwork, and you're getting charged $700, $800, $1,000 for them to go to a closing. And really, there isn't much they do anyways, except sometimes just screw up the deal. So as you can see, my level of sympathy for their dislocation is pretty minimal. But they're in the camp, but maybe they've always been losers. Now, if you're a lawyer out there, what can I tell you? You probably hate your job anyways. But hey, but they're now in a double camp of losers. All right. So these are the people that take the hits. These are the people that are suffering in this time, right? Now, it's a lot. Now, let's look at some further collateral damage. You think Home Depot's as busy as it was before? When people go to sell their house, what do? They fix it up a little bit. When people buy a house, what do? Well, they spend a lot of money and they fix it up, right? Now, they go buy materials at Home Depot or Lowe's or Menards if you're in the Middle West, and they buy the materials. Then they also hire contractors, and so some of those people have been affected. The painting companies, right? Now, one will say, yes, People will spend money on their house because they already own it. They got to paint it anyways. But when people buy a house, they're much more motivated to do something with it. When they go to sell a house, they're much more motivated to immediately do something with it, right? And so they are part of the collateral damage, all right? And so you have these, and what's another one? Furniture and appliances. You see how this ripples through the economy? If you don't think that furniture stores are hurting, because number one, people ran out and spent all of their money from COVID on stuff anyways. And you might say, well, they made so much money, but they're not making the money now. And they got the bills today. All right, so furniture stores, appliance stores. When real estate starts, I remember a year and a half ago, I think it was like the beginning of 2022. No, it was right. Yeah, it was like, let me think. Yeah, it was like the beginning of 2022. A furniture manufacturer down south laid off just a ton of people, thousands, because they knew this was coming. They've experienced this in the past, and they knew that if they didn't cut their people, then it would be unfair for the people, because they would then be deeper into a recession or into a bad time and wouldn't be able to get another job somewhere else. So in some respects, even though they say, oh, they're evil, they cut them, but because they cut them, they most likely were able to find another employment. We don't know if they like it as much or as much money. I don't know, but people get affected. Appliance companies get affected. If you think they're selling as many stoves, refrigerators, washers, dryers, dishwashers as they were 2 years ago, well, you're wrong. And, that's just the way it is. They're not. Because when people buy properties, they buy real estate, they put in new appliances. Do they do it every time? No. But do they do it a significant percentage of the time? Absolutely. So these are the people that have become, they're on the losing side of this. Now, I'm sure there's probably some other people. Oh, what's another group? The people that the new industry of people that were out there with drones, taking the photos, the pictures with the drones about real estate from above and around and all that. You think they're as busy as they were 2 years ago? No, they're not. That little job they had, that business they were trying to build, in many cases, they've been descaled. All these companies, all these people, in a sense, have been descaled. Now, you might say, I never heard that word before. Neither did I. I don't know if it exists, except I just made it up. But to scale is to grow bigger. In this case, you're descaling. You're growing smaller. We'll see if we can get it into Webster. Now, I asked you to stick around, right? So hopefully you've hit the like button. Hopefully you've subscribed to the channel already, because what the hell? But who's the winners? Who are going to be the winners? Oh, before we jump over there, let me go right back over to the losers, because there is one more pretty big category of losers, and that's all the people who bought apartment buildings in a couple of years back when the prices of the apartment buildings were sky high. And this is anything from, let's say, a 5-unit to 200, 300 units. So pick your poison of which size you want to talk about. But these guys could not make it. These ladies could not make the underwriting, couldn't make the numbers work when the fixed interest rate on a commercial loan was 4%. So what did they do? Like I've said in the past, they went and they put on an adjustable rate mortgage. And what's happening to them right now? They're starting to get creamed. Why? Because they've got commercial loans, and commercial loans work differently than residential. The rates can adjust in many of the commercial loans a lot faster. The reserves, you see, they want you to have a certain amount of money in reserves when you buy a house, but it's never a big issue because it's never much money. But when you buy a commercial building, an apartment building, they want you to have significant money sitting in reserve. And they have the right to demand that reserve to go up if times get bad, if they start to get scared in the economy. See, banks can screw up 14 ways to Sunday, and the government comes and bails them out. Their customers screw up, and what happens to them? They get thrown under the bus in foreclosure. That's just more of a commentary than anything else. But it's the truth, right? Just don't make your mortgage payment. See what happens. I'm not suggesting that. So in any case, so these banks have then said, these people now have more money they have to come up with. And sometimes it's been 10 times. So if they were sitting there and they had an $8,000 reserve, some of these banks are now requiring that to go up by a factor of 10. So now all of a sudden they got to come up with $80,000. So if they had an $80,000 reserve, now sometimes they're being told to come up with $500,000 or 800,000. And if they don't raise that money and put it in there within 6 months, what happens? They end up in default, let alone the fact that if they had that adjustable rate mortgage, they're heading there anyways. And then there's one more category of people that are going to end up in the loser category that did nothing wrong except timing. No one could argue this whole thing is based upon timing. I get it. But if you were out there and you had a commercial loan and it's going to come due, and it was a 5-year commercial loan, or it was a 10-year commercial loan, and it's going to come due between now and the next year, and your interest rate was 3, 4, 5%, and now they're going to tell you on a commercial loan it's 10 or 9, what do you think that does to your cash flow? What do you think that does to your just your ability to maintain that property? So there's going to be a lot of people that when they come up to get their loans renewed, right now they're sweating bullets. They're getting ready to put their properties up for sale. And if they put them up for sale, nobody buys it, then they got to start to discount it, right? And then, I guess this loser category continues on, is there's always office. So if you want to know, what's the whipping boy of real estate right now, it's commercial office, right? Because they got nailed in COVID when people didn't go back. Then it's gotten nailed with the interest rates. I read a study recently, I think I mentioned it before, that in the city of Chicago, when it came to office buildings, except for about 10 buildings, the average large tower skyscraper there, if it's not residential, is not even worth what the mortgage is on it. How's that for a kick in the ass? So when you're driving, if you're in the Chicago area, you know how beautiful that skyline, all those damn buildings are underwater. They could all easily be foreclosed on based upon the terms of the commercial loans. Because in a commercial loan, if the valuation doesn't maintain itself and it goes down too far as a loan to value, and the debt becomes too big of a percentage based upon the current level of equity, the current valuation, valuation and equity, then you have to come up with money. Then you have to come up with money in order to bring the equity and the debt back in line again. Or they have the right to do what? Throw you into default. So these are interest rates moving like this. And then on top of it, the COVID thing for commercial office has been just devastating for real estate. Now you might say, well, so who? Let's jump over now to where I was going before, and that is, who are the winners? Well, the winners right now are all the people that have a 3 or 4% interest rate mortgage, or 2.5%, and they don't need to sell. They are freaking winners. Congratulations, you won. Why did you win? Because for the first time in effing history, you get to beat the bank. You get to do an arbitrage of your cost of the money you borrowed from the bank and what the bank is borrowing money for. They're borrowing money from the Federal Reserve System, okay, at 5.25%, between 5 and 5.25%. And you're sitting there and you got a loan that they lent to you for the next 25 years at 2.5 or 3. So people, I'm not a financial advisor. Okay, I'm not trying to give you financial advice. But if I had a 2.5% loan, I would stop prepaying my loan. I wouldn't put one additional dollar down to prepay my loan. If you're in the winner category, don't put yourself over, don't push yourself back to the losers. Because if you got a 2.5%, 3% mortgage, and you're arbitraging the bank by 2 and 3 and 4%, look at what it costs to get a mortgage now. That makes you a winner. Don't jump back over into the loser category by prepaying it. I wouldn't. I'd rather use the money that I was going to prepay them and invest that in other investments. And we'll talk about what that might be another day. But why prepay something when the cost of that capital, so if you is so damn low, it may never in all of history be 2.5% again or 3% mortgage again, unless there's some absolute insane thing that happens that none of us want to happen. And so that's why you have to look at this from the standpoint of an investor. If you've got that 2.5%, open up your eyes. Quit listening to these people that just say, pay off your mortgage. Take those dollars that you're going to prepay your mortgage and invest them somewhere else because you think you can get a better rate of return. Hell, you can buy treasury bonds. Let's just do that. At 5%, you can get a 30-year treasury bond at 5%. You can get a 2-year treasury bond at 4.8 or something like that now. So take that money and you're doubling your. So instead of instead of paying out, you're doubling your return. So you're making 100% over the cost of those funds. So if the cost of those funds is basically 2.5%, right, on the prepay, and you're making 5, you doubled that. So you're making 100% over cost of funds. That makes you a giant winner in this process. So quit prepaying those damn loans. You get to own the bank for the first time instead of the bank owning you. Does that make sense? Who the other big giant category of that is basically winners right now? Well, they're in the process of becoming winners. They're sitting there. They're raising money. They're putting cash together. We're at a point now for a period of time where cash will be king. What do they mean by that? Because it's what you get to do with it once the prices of the apartment buildings start to come down, when these guys have to refinance a 3 or 4% loan to a 10, and they can't do it, and then they got to dump it, right? So what's going on in some of these apartment buildings right now is what happened in the residential side on single-family homes back in the 80s and back in 2008, right? Because they had adjustable rate mortgages, and then they couldn't afford them anymore, so they had to dump those houses. So there's going to be opportunity in all sizes of multifamily, from 5 units up. Now you might say, well, how do I take advantage of that? Figure some shit out. And you're doing that because you're listening to me. So we teach you how to do that, right? But, this is a time where the winners are going to be the people that get to arbitrage the bank because they got that great loan and they don't need to move. They don't want to move, which is the vast majority of the average population in a given year, right? And then the investors that are getting ready to take advantage of the opportunities that come to the market. And they might be off-market deals. So how do you become even a bigger winner? Start talking to your local banks. Build some relationships with the commercial lenders in the banks. Understand what the real estate owned department, because they're going to start to get fat again with property. They're going to be the big winners. So I hope you really liked this video. I hope you liked it so much that you liked the damn video. You push the button, right? And you subscribe to the channel. And remember what I always say, right? Think big. Start now and grow fast. V. Rigoni, Max, high performance real estate opportunity. My question to you is, do you want to be in the loser category or do you want to be in the winner category? That's up to you. Figure it out. Talk to you soon.